Hey everyone, I'm going to be starting out today's live workshop on not just the tax planning series, but understanding your taxes specifically. Today is what we'll be talking about. And I'm excited about this because tax planning is basically one of the key areas that a lot of people just are not well known on. They're not familiar with how their tax situation works. And it's super important because there's ways that you can be more efficient with it and basically avoid paying more taxes than you need to. So that's really the point of understanding your taxes. Not only will you understand and feel more confident and clear as to why you pay so much in taxes, but you'll also have a great groundwork to know how to navigate these things and control your taxes moving forward. And that's what I'm really excited about sharing with you today. And so my name is Lucas Caceres. I'm a certified financial planner. I started Level Up Financial Planning 3 years ago now, and I started Power Up Tax Planning Services really to complement my clients at Level Up Financial Planning earlier this year for 2020. And it's been a lot of fun to be able to help people navigate their financial situation and make sure that they're making informed and confident financial decisions. And that's really what that's all about. That's about all I'm going to do as far as talking about Level Up Financial Planning or even the Power Up Tax Planning Services. This isn't about to be a sales pitch. Hopefully a couple of my clients are even on here anyways. So it's really going to be purely about education, information to give you confidence and empowered to control your financial situation moving forward. So with that, I'll take you to this exciting slide. It is the disclosure. So this is required by law that I provide these things. And so I'll give you a second to read over there. It looks like I got a comment coming in already, but yeah, definitely feel free to write questions. Oh, awesome. I got one of my tax friends in here. So if there's ever anything that comes up that's outside of my league, I'll definitely be able to even lean on him to provide some information and insights. But yeah, so that's enough time to read the disclosures. Again, that's just required to basically state that this shouldn't be taken as specific advice to your situation. This is more for just making sure that you understand this is educational. This is for you to start to gain some information. By the end of this, you'll have a good idea about why your taxes are the way they are and why you pay as much as you do, but you might not necessarily be able to go and start doing taxes for a living after watching this. The person, my friend that's on here, spent a lot of time studying. I had to take a bunch of classes to be really knowledgeable on this, then even additional kind of studies afterwards. But yeah, you should be pretty confident about your own specific financial situation, or at least know what questions, what holes you could start digging into a little bit deeper. And so here's a popular quote, and it makes a lot of sense even now. So obviously, President Trump, he's healthy right now, or kind of on that trajectory. So initially, I wasn't going to say this because if he was still not feeling well, I didn't want to be distasteful. But now, since things are looking good, but even Trump has to pay taxes. He paid $750 in taxes, and you're probably thinking to yourself, if this is newsy, you're probably like, what? $750 is all he paid? Yeah, it's pretty crazy. Even he had to pay taxes, though, even though it's not nearly what you would expect from someone of his stature and kind of his business background. But yeah, Benjamin Franklin said, in this world, nothing can be said to be certain except for death and taxes. And even Trump couldn't avoid that, even though he got pretty close, right? You got pretty close to zero with that. I don't think I'll be able to get your taxes that low, even with any information I provide today. But what I will do is give you a couple tips and ideas of how you could start to move in that direction and just have more control over when you want to pay more taxes or not, because there are some tax efficiencies to be had as you kind of move along. So the main outlines that we'll cover today is going to be the three major tax rates to me that I think matter the most to you and that you should know. You should be aware of these things. The deductions versus credits and how those things compare, because I know a lot of times people think that they're going to get some type of deduction, and all of a sudden there's been a lot of tax law changes. They're always changing, it seems like, the last few years. And so you want to get clear as far as what those are and when they may apply to your situation. So we'll talk through those examples. I'll also just give you a detailed example of how to go through and calculate this for yourself as well. So it's going to be something that if you happen to have your taxes available, you can pull them out and you can kind of follow some of this line by line with us in some instances. And then ultimately how to control your taxes, right? That's why we're here. That's why we're trying to get this additional information and education, because you actually can control these things quite a bit. So Speaking of control, things that we can't control all that much unless you're self-employed is going to be the Medicare tax that we pay, the Social Security taxes we pay. Good news on Social Security is once your income crosses a certain threshold, you actually stop paying that Social Security amount. You get a little bit further outside of that, and then all of a sudden additional Medicare tax kicks in. So those are things to be aware of. If you're self-employed, if you're a freelance contractor, and you're responsible for paying your employment tax, you actually pay double that. So it's going to be 15.3%. That's important to be aware of. That's one thing that shocks a lot of people when it's their first year being self-employed. You're like, oh, yep, I'm withholding my Social Security and Medicare, but you're probably only withholding half of what you thought you were going to need to, because you actually have to pay double. You may not realize this, but if you are an employee, or when you were an employee, your employer is actually paying that other half for you when you're an employee. So that's why it's actually, the government receives a lot more than what we just pay into Social Security and Medicare for our records. So the three major tax rates that to me I think matter the most, it's your marginal tax rate. So why there's a couple of different rates to be aware of. So in the United States, we have a tax system that's called progressive. So it means that you pay different amounts of taxes on different levels of income. So I'll provide you an example so it'll be a lot clearer, but it just means that just because you receive $100,000 in income, if your marginal tax rate where you land is 22%, that doesn't mean you're paying $22,000 in taxes for federal taxes, because it's progressive. You're actually going to pay at a much lower rate, then it's going to incrementally get up as your income phases up. And so it'll be different rates for different parts of that $100,000 you earn basically. So we'll dig into examples so you can see that. Capital gains rate, that's important because a lot of my clients and just a lot of people have investments. You might have investment property. You might even have a home that you've lived in and it's appreciated in value. Sometimes you might end up having to pay taxes when you sell these things if you have employer stock. So that's when capital gain rates come into play. The cool thing is that it's way better, way more favorable than the earned income that you receive. So we'll look at those and see how they compare. And then the thing that I think is super critical and crucial is to understand that your effective tax rate, because we are in that progressive system, you're not paying that 22% on all $100,000. That means that there's a lower tax rate that you end up paying, and it's called your effective tax rate. We'll talk through how to calculate that. So first, let's look at the marginal tax rates. And you can see here, this is for single filers. I won't spend too much time on this because it's just pretty much reading the numbers and kind of where you fall in. But it describes that first about $10,000 or so, you're going to be paying at 10%. Then the next $30,000 or so, you'll be paying at 12%. And you kind of progressively grow through there. And so that means even if you have $100,000 in income, you're not going to be paying 24% on all of that. You're just going to be paying that on the threshold that it crosses of that $85,526. And I'm not going to work through the joint filing one, but because you're married filing jointly, if that's the case, they give you more wiggle room, right? They allow you to receive more income before you get kind of hit by those taxes. So essentially double most of the time. Every now and then there's some tax laws that change, and sometimes the married filing jointly isn't exactly double of the single. It depends on what's going on in Congress, what kind of hodgepodge tax laws they're trying to force through, because sometimes these things don't make sense, and we'll probably see that on some things here soon. So the capital gains tax rates, it gets a little bit more complicated. There's short-term capital gains, and then there's long-term capital gains. Short-term is 1 year or less. So if you held something exactly 1 year and sold it, you're still in the short term. You actually need to go 1 day over that. That's important to know. That was always on my tax questions in school. And I think I got it wrong once. And I'm one of those people that I like to learn from my mistakes. And so I'm like, oh, it's 1 year and a day in order to get that preferential long term. And that's when you hold it greater than 1 year. So at least 1 year and a day, then you qualify for long-term capital gains tax rates. And the difference and the reason why you want that to be the case is you can see this one that was small enough, I was able to put the single filers and joint filers side by side, but these are the capital gains tax rates. So if your income happens to be less than $40,000, you actually don't pay anything. Even once you go there, there's a huge range. It's almost $400,000 range where you can go up and only pay 15% on those capital gains. And so that's way better than if you, again, going back, looking at those marginal tax rates that you could be paying. If you're paying 24% on your income that goes over 100,000, but you're able to sell some assets, some investments that you have, and only pay capital gains on that, only on the gains portion too. That's always something that a lot of people forget, is when you have a capital gain situation, you are only going to be paying capital gains taxes on the gain from what you purchased in. Your purchase price is called the cost basis. So that's important to be aware of. I see a lot of people freaked out when they have employer stock purchase plan, or if they had RSUs that vested. One thing that happens is once you've had those for a while, you do have a cost basis. So you're not paying 100% of that value that you sell it for in capital gains tax rates. It's going to be a portion that you take the sale amount for that investment minus what your cost basis is, how much you originally paid for it, or how much you originally paid taxes on it if it's like an RSU that vested. And then basically you only pay that 15% or 20% on that amount. So it's not nearly as bad as sometimes people freak out about. So you can feel a little bit better that those capital gains rates are awesome. Stay tuned, right? There's an election coming up. One of the last workshops I'll do is what's the impact that the election might have on your taxes, because they've been trying to get rid of these capital gains tax rates. So right now, this is law as of 2020, but that's subject to change moving forward. And if that's the case, we'll definitely be getting some updated workshops for that. So this is going to show you how to calculate your effective tax rate. We talked about the marginal tax rate. We talked about capital gains. And now this is how you calculate your effective tax rate. At the end of the day, so 2020 ends, there's not going to be too much wiggle room as far as how you can change your tax application. There's a few instances where you can with retirement accounts, HSA contributions. Sometimes you can travel back in time all the way up until April 15th of the following year. But for the most part, most of your tax situations will be baked in. So whatever that amount is, you divide that by your total income for the year, and then that's what your effective tax rate. And I'll give you an example here. So let's say that you owe $6,000 in taxes for 2020, and your income, your total income for the year was $100,000. That math's pretty easy. I'm trying to use easy numbers here. And so the effective tax rate is 6%. That actually is not that bad. So every now and then I'll run into clients that make about that much. And if they're married filing jointly, if they have kids, sometimes you can get that effective tax rate to be pretty low. And that's a big difference on what you may think you would be in like that 22%, 24% bracket, about that range. So it's important to know these things and see how they compare. And then it just kind of empowers you to make that decision of, well, should we change this? Should we try to increase how much we're paying in taxes? Because there might be some benefits down the line if we're doing like Roth accounts or something like that. Or should we decrease it and reduce our taxes? And we'll go through a couple of examples of how you can do those things. So the big tax reducers, other than just making less income, which no one wants to do. I think that's one huge, there's that popular saying, right? More money, more problems. That's definitely the case, but taxes are only a portion of the income that you earn. So very rarely will you be penalized in taxes. There are some instances, and we'll actually cover this in the taxes and retirement workshop that's going to be in a couple weeks. But there's some instances where you receive more income, and it's brutal when it comes to taxes. But most of the time, if we're just talking about your marginal tax rates, you're still gonna end up with like 70% more income than you're expecting, even when there are taxes. So more income is always a good thing, even if there is more taxes associated with it. But how you can reduce taxes is with deductions. There's tax deductions. That's going to reduce your taxable income. That's different than tax credits. Tax credits reduce your taxes. And if you guys remember back to when you were in math class, that's a greater than sign in the middle. So credits are always greater than deductions. If you receive $2,000 tax deduction, that is not the same thing as a $2,000 credit. So most of the time, the credits are going to be way more valuable when you're trying to compare those things side by side like that. And here's an example of why that's the case. So if I'm going to use the same income levels for both, and I'm always going to be using 100,000 just to make the math easy on everyone. So income for deductions, we'll focus on that left side for now. 100,000, let's say they get a $2,000 deduction, And so now their taxable income is $98,000. If they're in the marginal tax rate of 22%, that only saves them $440. So that deduction, obviously it saves them money. That's good, but it's not going to be quite as good as the tax credit. So we're going to look at a taxable income of $100,000 again, keep that even. This time it's a credit that they're going to receive for $2,000, and the marginal tax rate still 22%. We're trying to keep these things pretty similar, other than you see the tax savings. It's actually still that $2,000. So $2,000 is definitely greater than $440. And in case you need to see where I'm looking at on there, I added some fun little images there to call those out for attention. So when it comes to deductions, we'll talk about deductions specifically here for the next couple of slides. So for the deductions, the first thing that you'll realize is you have to choose, or basically it'll be chosen for you once you kind of look at how things go. There's the standard deduction, and that just means that there's set amounts already provided by the IRS that says, yep, you can reduce your income by this amount. If you're an individual, you see it's $12,400. If you're joint filing, $24,800. If you're head of household, that's $18,650. So that's how much you're just able to reduce your income right off the top. That's free. Basically, you're paying 0% taxes on that first chunk of dollars for the standard deduction. Most of the time, with the tax laws that happened in 2017, most people are going to take the standard deduction. Every now and then you get to the spot where you actually have enough itemized deductions to take itemized deductions. So in this situation, it's standard or itemized. You basically have to choose between the two. You're always going to take the higher one. The thing with itemized is the biggest thing that happened in 2017 is they capped the state and local tax. So if you think about your state income tax, if you think about property taxes, those things tend to be pretty high sometimes, especially in some parts of the country. And those are capped at $10,000. So already you're going to have a hard time, if you're married filing jointly, trying to find another $14,800 of income to get above that normal standard deduction you'd receive anyways as married filing jointly. The other itemized deductions you get to add in there to see if we can cross that threshold is the home mortgage insurance or interest. Charitable contributions is a big one. There's going to be a specific workshop for that one too. So I tried to pin all the ones that I think add the biggest value and the most planning opportunities and strategies around for my workshops as standalone, so we can get into the weeds with those, and then medical expenses as well. So those are really the key ones. Every now and then there's some other ones that are less known, less common that will probably fall into there. But yeah, if the numbers don't add up for your itemized deductions to be greater than your standard deduction, you're going to take the standard deduction. Luckily, there's still a few other standalone deductions that even if you do the standard deduction or you do the itemized deduction, you still have access to some of these other common deductions. So you can still deduct tuition. All these things may have limits, so you always want to look into that and see if there's any income limits that apply, or just limits in general. If you had $1 million in tuition, there's usually caps on these types of things. And so, yeah, just be aware of that. The tuition usually is a deduction you can have. Student loan interest, IRA contributions, that's a big one if you're eligible, and HSA contributions, again, if you're eligible. There's a few of these things that you can tack on top of, specifically the IRA contributions, if you're allowed to make them, and the HSA contributions. You have until April 15th of the next year. So those are the few situations where you can actually go back in time and still, it could be 2021 in April, and you could go back and reduce your 2020 taxes. So that's something I always like reminding people as an opportunity. If they have too much cash or something like that they don't necessarily need, we can do some of these fancy things. Again, credits are going to be more valuable from a pure dollar-to-dollar standpoint. These definitely usually have income limits, so that's something you want to be aware of. So there's the education credits, there's the lifetime learning, there's American opportunities. They have different limits, they have different time frames that you can use them. So that's important to be aware of. There's the child tax credit. I was going to throw some pictures of my kids up here and just say, hey, this is $2,000 child tax credit. This is $2,000 child tax credit. And this is $2,000 child tax credit. That's a pretty valuable tax credit. Obviously, kids are more expensive than $2,000. So it never makes sense to have children purely for the tax credit, but at least there's some kind of government incentive or help, I would say, in some of those child care costs that you might end up running into. Child independent care credit, that's something that you may be eligible for, and a lot of people have been able to use recently. And then earned income credit, that's typically for lower income earners, but if you have a year off, if you're unemployed, there's some instances where you may cross into these things for 1 year only, and it could be a good tax planning opportunity. If your income dramatically falls, yes, it's obviously not a good thing that there's not that much income coming in, but there's some strategies you can use to actually take advantage of that situation. So that's something I've done with my clients when they reach those different periods. So this is gonna be a full example. So if you did happen to get out your taxes from last year, you can kind of follow along mostly with this. So this is gonna go straight through it. If your income's $100,000, I'm gonna use this example as a single filer just to kind of keep it nice and easy. Obviously, if you're not a single filer, you're going to want to look at a married filing jointly tax bracket to see what your marginal tax rate is. But I'm going to show you all the way through here. You'll see some pretty identifying information that you can run these calculations yourself. So whatever your total income is that's reported on your W-2s, also if you have the employer stock purchase plan, if you have dividends, things like that, sometimes these things flow through to your income as well. So in this example, they're going to receive an HSA deduction. They contributed $2,000. They're going to reduce their income by $2,000. They are going to take the standard deduction of $12,400. That gives them the adjusted gross income of $85,600. And so the taxes before credit, I'm going to show you the taxes right here. It's that $14,622. But now, probably more importantly, I'm going to show you how we get to that number. So each one of these things here, we're starting with the $85,600 because of the standard deduction. So that standard deduction, that first chunk was free money. You paid 0% on that first amount. But now we have $85,600. Let's go and figure out how this progressive tax system works. And so the first 10% bracket, you're going to pay $987 essentially. Then the next bracket, you're going to pay $3,629 for that chunk of that $85,000. Then you're still going to be in the 22% bracket. You're going to fill that up completely as of right now. And that's $9,987. And then look at it. They just kind of limp into that 24% tax bracket, and they only pay $17 once they get to that stage. So that's how we came to that total at $14,622. That's why it's progressive, because if we had a flat tax system and you were in the 24% bracket, you'd pay $24,000. Obviously, if there's that deduction, that standard deduction, that wouldn't be the case. It'd be a little bit less, but even in this situation, it'd be pretty sizable. The progressive tax system provides a lot of tax planning opportunities, though. That's why I enjoy it. It makes it complex, but once you know what's going on, then it makes it really cool and fun to be able to navigate these things. So that's how you find out what your normal taxes due would be, but then you get to apply any tax credit. So this person has one child that they have the child tax credit for, and so that reduces their total tax liability to $12,622. So if you remember, they limped into that 24% tax bracket. So that's their marginal rate. But again, they're not paying 24% on that full $100,000. They're not even paying the 24% on that $85,600. What they end up paying is 12.6%. That's their effective tax rate. And that's important to know, because a lot of times people think that I'm in the 24% tax bracket, I'm paying $24,000 in taxes. And that's not the case. They never actually pay attention to their tax forms when they're completing those. And there's, again, just a lot of opportunity, whether you're in retirement, whether you have unique income years, where you can actually play some games, you can create some efficiencies when it comes to your tax planning strategies. And so here's a couple of ways that you can impact and control your taxes, probably in ways you haven't even realized. And so basically, even though we're close to the end of the year, I still factor in there's about 15 different ways that you can control your taxes. You can reduce your taxes. You can do some stuff right now that would be tax neutral. You can offset some of the taxes. So one of the big ones is, well, I have stock options. I don't want to have to pay taxes on them, so I don't want to exercise them yet. Well, there's ways you can offset those funds by contributing to your 401k, contributing to IRA, contributing to HSA. There's ways where you can move these things around and offset taxes so it's not as painful. And so that's important to be aware of, because I think so many times people make horrible financial decisions because they don't want to pay more taxes. Well, there's ways around it. There's so many different ways around it. It's crazy. And there's tax efficiency things. So speaking of tax efficiency, we're heading towards the end of the year. If you had stock that has gone down in value and it's outside of a retirement account, you can sell those things, and that could be a loss that you can carry on to your income. After you have gains somewhere else, you can offset the tax losses to offset the gains and just kind of reset those things so that you never have a painful year where all of a sudden you have to sell things and it's a high income year, all these things are up and you're just paying a lot of capital gains taxes, or even floating into ordinary income taxes. So there's huge ways that you can create efficiencies and paying taxes now to avoid in the future. I know it doesn't sound like it makes sense, but there's a lot of value in certain instances where that makes sense. That's going to be the very next topic next week, next Thursday. So definitely if this has been opening your eyes and you want to find out more, next week we're going to talk about traditional IRA accounts, traditional 401k accounts, but more specifically and more importantly, the Roth IRA or the Roth 401k. There's some huge value, especially when it comes to planning opportunities there. And I kind of highlighted some of these things, but basically those descriptions, those ways you can reduce, create more efficiency, offset, most of those things you can do within these kind of categories: retirement accounts, health savings account, employer stock, charitable giving, non-retirement assets like employer stock and things like that. So 15 ways basically within these few areas of windows, and you can do a lot of cool things. It does help as you move through your career and you have more things to toggle and pull. But early on in your career, there's a huge advantage too of just doing the right things, making your taxes as efficient as possible, because then you get a lot more flexibility later on in life. And so here's just a couple of the next upcoming workshops that we're going to talk about. Definitely let me know if you have questions, comments. I'm glad that we kind of covered ground pretty quickly. This hopefully gave you some insight as to why you pay the amount of taxes that you pay and how you might be able to start triggering these things and maneuvering them and controlling them the way that you want. But yeah, next week it's going to be, should you have a Roth? We'll talk about traditional 401ks, traditional IRAs as well, but the Roth is definitely going to be the focus and highlight. Gift tax strategies. So if you're gifting to charity, if you're gifting to friends and family, children, that's going to be the topics we'll cover there. If you're approaching retirement, taxes in retirement is going to be a huge one because Social Security gets taxed potentially. There's Medicare, premiums go up. There's a lot of things that happen. If you have early retirement and you have to pay for your own health insurance, there's some huge value in tax planning before that, because yeah, you can reduce your premiums pretty substantially if you have a good tax diversification, good tax efficiency, and have a plan going into it. And then there's going to be an election coming up this year. Hopefully nothing gets delayed and we're able to keep this on track. But after that Thursday after that election, we're going to talk about what that potentially means to your taxes. So do we think things are going to change? Does that change some of the strategies that we've been talking about? Stay tuned and definitely reach out. Let me know if you have questions, even if it's not here today. You can shoot me an email. You can find me on social media. Let me know what things you want answered. And if I can answer it pretty quickly, I might just do it there. But if it makes sense, I can incorporate it into these future workshops. And you can see there's a couple of different ways. Again, this is not meant to be a sales pitch at all, but if you want personal finance resources, I create a lot of free content. This workshop being just one of those ways I do it. I have a podcast, I have strategy guides, I have cheat sheets. Not all of them have made it to my website just yet. I probably am behind in uploading some of those resources. But if you're following me on social media, basically you're catching those things as I'm creating them, as my clients are asking me questions. That's really one of the things that drives the content I create. If I get the same question more than once, more than a handful of times, I'm like, I know the answer. So let's make sure more people know about these things so they feel more confident about their financial situation. There's the tax planning I do. I'm only taking on limited clients. So if that's something you need, definitely reach out. But obviously there's plenty of different ways you can have your taxes done. Hopefully this gave you a lot of information as to just understanding, even if someone else is doing your taxes, even if you're using TurboTax or something, you just have a better understanding of, well, why are they asking me these questions? How are they relevant? How is it actually helping or hurting? And you can always shoot me an email at my most used email address, which is lucas@levelupfinancialplanning.com. And yeah, hopefully you guys obtained a lot of value. Reach out, ask questions. I'm here as a resource for you. And yeah, I look forward to these next few workshops. I'm excited about tax planning and just basically controlling your situation so that you always know what's going on and are doing the best thing for you. Never pay more in taxes than you need to. Thanks for joining me today.